Good day. Toby Lab from the Accounting Club, where we enable you and your business to succeed. Very quickly, I'd like to talk about one tax trap to avoid, and that is on director's loan account. All right, so relevance. This is relevant to limited company directors, and a director's loan is more or less what I say is more or less a credit card account. So if you have a credit card, you have a limit, okay, and then you have you can use it and then you pay back. And that's what the director's loan is really, without interest. And the limit on that, when I say without interest, I mean, credit card, you pay interest. On director's loan, we don't have interest, but there is interest, and I would explain that in a bit. Right, so director's loan is usually consists of expenses that have not been taken, funds that are drawn out of the business, not in the form of salary expenses, expense reimbursement, or dividends. So let's say you take out a salary of £1,000, dividends of £1,000, that's £2,000. And then you pay expenses through the business, or you buy something for the business. You incur an expense of maybe £500 in your name, and then the business pays that back to you. That's £2,500 you can take out from the business. Now, if you take out additional £500, making £3,000, that £500 additional is a director's loan. So the business is literally lending you money, and that's a director's loan. And you can have your loan account can go up to £10,000 or more. Okay. If your financial year end is say 31st of December 2024, or let's just say 31st December, then you want to make sure that the balance on your director's loan is no more than £10,000. Where it is more that when it is £10,000 or more, then your company will pay corporation tax on the balance at 33.75%. Okay, so you want to monitor this account to avoid paying additional tax, and it doesn't stop there. Okay, where the balance remains outstanding, right, you may be liable to benefit in kind tax, where the loan is reported on your tax return and then you pay tax on that. So it is important to make sure that the balance on your loan account is below 10,000 around the end of your financial year. Now, after a financial year and after 31 days, it can go back above, not before. Okay. Now you can avoid having this being treated as you can avoid tax being deducted on this account by making it what you call a commercial loan. All right. So you pay your company interest for drawing out a loan, right? And on that loans, you can find information on that on gov.uk website there, and you can see you have a lot of information there, and that's what I've tried to explain to you. So if you repay the loan within 9 months of the end of your accounting period, then you can get a refund of the tax that you pay. If you do not repay within 9 months of the end of your accounting period, right, then you pay corporation tax at 33.75%. If the loan is written off, then the company will have to deduct national insurance, and you as an individual will have to pay income tax on that. Now, if you paid your company interest on the loan above the official rate, right, then you don't have to. You won't have to pay that tax, and it won't be treated as income to you. So in director's loan, you may consider making it a commercial loan rather than just the beneficial loan. A beneficial loan is where there's no interest. A commercial loan, there's interest, and you pay back, and you pay the interest to the company. So that's a tax trap to avoid. So if you need help understanding director's loan on any area of tax, if you need help with tax planning, we are available to help. Reach out to us, and we'll be glad to help you out. Once again, Toby from the Accounting Club, where we enable you and your business to succeed.